Welcome to i-TUTOR Economics NCERT series. Today we are starting a very important chapter, Money and Credit. Money as a medium of exchange. Money is part of our everyday life. If you just look at one single day, you will see many situations where money is involved. For example, when you buy a notebook, pay your bus fare, recharge your phone or go to a doctor. Sometimes money is used to buy goods like food or clothes, and sometimes it is used to pay for services like getting a haircut or traveling in an auto. And sometimes we don't pay money immediately, but we promise to pay it later, like when you take something on credit from a shopkeeper. So money appears in different ways in our daily transactions. Why do we use money for transaction? The reason is very simple, because money can be exchanged for anything we want. For example, let's take the case of a shoe manufacturer or a shoemaker. Suppose a shoemaker wants wheat. He will first sell his shoes for money, then use that money to buy wheat. Now imagine if there was no money, the shoemaker would have to find a farmer who not only has wheat to sell but also needs shoes. This is very difficult. Both people must need each other's good at the same time. This situation is called double coincidence of wants. What is meant by double coincidence of wants? It means what one person wants to sell should be exactly what other wants to buy. In older times, when people exchange goods directly without money, this was called barter system. In barter, double coincidence of wants is necessary. But with money, this problem disappears and exchange becomes easy. In contrast, when money is used in economy, things become simple. Money acts as a middle step or an intermediate step. So, the shoemaker doesn't need to search for a farmer who wants shoes. He just has to sell his shoes to anyone who pays money. Then with that money, he can buy wheat or anything else. That's why we say money is an intermediate in exchange. It stands in the middle of buying and selling. Because of this, money is called medium of exchange. Now, modern forms of money. In the past, people used anything valuable as money. For example, in very old times in India, people used grains and cattle as money. Later, people started using metal coins made of gold, silver and copper. This continued for hundreds of years, even up to the last century. So money has changed its form over time, from grains to cattle to metal coins, and now to the modern forms of money we used. Now, currency. Today, the most common form of money is currency. That means paper notes and coins. Unlike old forms of money like grains, cattle or metal coins, modern currency is not made of precious metals like gold, silver and copper. It has no value of its own. You can't eat it or use it as a material. So, why do we still accept it? Because the government says it is money. It is accepted as a medium of exchange because the currency is authorized by the government of the country. In India, the Reserve Bank of India issues currency notes on behalf of the central government. So note that point. In India, Reserve Bank of India is issuing currency on behalf of the central government. By law, no one else can make money and everyone must accept it to settle transaction. This legal backing makes the rupee a trusted medium of exchange. That means everyone should accept it. Everyone accept it for buying and selling. Deposits with banks as a form of money. Deposit with banks. People don't always need all their money as cash for daily life or daily use. For example, a worker gets a monthly salary. At the beginning of the month, they have extra money they immediately don't need. Instead of keeping it at home, they deposit it in a bank by opening a bank account. Banks keep the money safe and even pay interest on that deposits. People can withdraw money whenever they need it. Since these deposits can be withdrawn on demand, they are called demand deposits. Since the deposit in the bank accounts can be withdrawn on demand, these deposits are called demand deposits. Demand deposits aren't just safe place to keep money. They can also be used to make payments. Instead of giving cash, a person can pay by check. A check is a piece of paper that instructs the bank, pay this specific amount from my account to the person named on the check. This facility allows bank deposit to act like money because you can use them to buy goods and services without using cash. So, check payments. Let's look at this. Look at this scenario. A shoe manufacturer, M. Salim, he needs to pay his leather supplier. Instead of giving cash, he writes a check for the exact amount. Look how it works. The check is a paper instruction to the bank, like pay this money from my account to the person named on the check. The leather supplier deposits the check in his bank account. The money is transferred electronically from M. Salim's account to the supplier's account in a few days. Why it matters? Because no physical cash is used. It allows safe, convenient and traceable payments. This makes bank deposits like money, giving them the medium of exchange role in the economy. So look at the part of this check. Account number is given, then bank branch code is given, and check number and coding is also given. Thus, we see that demand deposit possesses the essential features of money. The facility of checks against demand deposit allows payment to be made directly without using cash. Since demand deposits are widely accepted as a means of payment, along with currency, they form a part of money in the modern economy. It is important to remember the role of banks in this process. Without banks, there would be no demand deposits and no check-based payments. Modern forms of money, both currency and deposits, are therefore closely linked to functioning of the modern banking system. Now, loan activities of banks. Let us continue the story of banks. What do banks do with the deposits they receive from the public? There is an interesting mechanism at work here. Banks keep only a small portion of their deposits as cash with themselves. For example, banks in India currently hold about 15% of their deposits as cash. This cash is kept aside to pay depositors who may come to withdraw money on any given day. Since only a few depositors withdraw cash on any particular day, the bank can manage with this cash reserve. The large portion of the deposits is used by the banks to give loans. There is a huge demand for loans for various economic activities. Banks thus use the deposits to meet the borrowing needs of the people. In this way, banks act as intermediaries between those who have surplus funds, that means the depositors, and those who need funds, that means borrowers. That means in this way, bank acts as intermediaries between the depositors and borrowers. Banks charge a higher interest rate on loans than what they pay to depositors. So the difference between the interest earned from borrowers and the interest paid to depositors is the bank's main source of income. What is the main source of income of banks? The difference between what is charged from borrowers and what is paid to depositors is the main source of income. Now, two different credit situations. Many of the transactions we carry out in our daily lives involve credit in some form. Credit or loan refers to an agreement in which a lender provides money, goods or services to a borrower with the promise that the borrower will repay it in the future. So credit refers to an agreement in which the lender supplies the borrower with money, goods or services in return for the promise of future payment. Let us understand how credit works through the following two examples. First one, festival season. Salim's story, it's a Salim story. Okay, it is festival season. 2 months from now, and Salim, a shoe manufacturer, has received an order from a large trader for 3,000 pairs of shoes to be delivered in a month. To complete production on time, Salim needs to hire additional workers and buy raw materials. So to meet these expenses, Salim obtains loans from two sources. He asks the leather supplier to provide leather now and promise to pay later. He takes an advance payment from the trader for 1,000 pairs of shoes, promising to deliver the full order by the end of this month. At the end of the month, Salim delivers the order on time, earns a good profit and repays all the money he borrowed. In this case, credit helps Salim meet the working capital needs of production. It allows him to cover ongoing expenses, complete production on time and earn a profit. Here, credit plays a positive and vital role. So here, credit therefore plays a vital and positive role in the situation. Let's look at another example, Swapna's problem. It is a cautionary tale. Swapna is a small farmer who grows groundnut on 3 acres of land. She takes a loan from moneylender to cover cultivation expenses, hoping that her harvest will help repay the loan. Unfortunately, midway through the season, pests destroy her crop. Even though she spends money on pesticides, the damage is severe and she cannot repay the loan. Over the year, the debt grows larger. The next year, Swapna takes another loan for cultivation. Even though the crop is normal this time, her earnings are not enough to clear the old loan. She gets trapped in a debt cycle and has to sell part of her land to repay the moneylender. This example shows that while credit can be helpful, it can also become dangerous if the borrower is unable to repay, leading to financial distress. In rural areas, the demand for credit comes from crop production. Farming involves significant expenses on seeds, fertilizers, pesticides, water, electricity, repayment of equipments and so on. There is usually a gap of 3 to 4 months between the time farmers buy these inputs and the time they sell the crop. Farmers generally take crop loans at the beginning of the season and repay them after the harvest. The repayment of loans largely depends on income from the crop. In Swapna's case, the failure of the crop made it impossible for her to repay the loan. She had to sell part of her land to clear the debt. Instead of helping her improve her earnings, credit left her worse off. This is a class example of debt trap, where credit pushes a borrower into a situation where credit pushes a borrower into a situation from which recovery is very. We can see two contrasting situations. In one case, credit helps increase earnings and the person is better off. In another case, due to crop failure, credit leads to debt trap and the borrower is much worse off than before. Thus, whether credit is useful depends on the risk involved and whether there is some support available in case of loss. Now, terms of credit. Every loan agreement specifies an interest rate, which the borrower must pay to the lender along with the repayment of the principal amount. In addition, lenders may require collateral, that means security against loans. Collateral is an asset that the borrower owns, such as land, buildings, vehicles, livestock or bank deposits, which is used as a guarantee to the lender until the loan is fully repaid. So what is meant by collateral? Collateral is an asset that the borrower owns, such as land, buildings, vehicles, livestock, deposits with banks, etc. and uses this as a guarantee to the lender until the loan is repaid. If the borrower fails to repay the loan, the lender has the right to sell the collateral to recover the money. Common examples of collateral include land titles, bank deposits and livestock. Now, credit in rural areas. In rural areas, most credit is needed for crop production. Farming involves significant expenses on seeds, fertilizers, pesticides, water, electricity and repair of equipments. There is usually a gap of 3 to 4 months between buying these inputs and selling the crop. Farmers typically take crop loans at the beginning of the season and repay them after the harvest. Repayment depends heavily on the income from the crop. Let's take example of Salim and Swapna. Salim, the shoe manufacturer, when he needs credit to buy raw materials and hire workers to complete a large order of shoes, the risk was demand for the shoes and timely delivery. And the outcome is he delivered the order, made a profit and repaid the loan. So the lesson is credit helps Salim increase his earnings. What about Swapna? Why she needed credit? To recover cultivation expenses on her groundnut crop. What was the risk? Yes, crop failure due to pest, climate or other factors. What was the outcome? Crop failure made repayment impossible. She had to sell part of her land. And the lesson is credit pushed Swapna into a debt trap, leaving her worse off. So takeaway is credit can be helpful when it allows people to earn more than they spend and repay loans easily. Credit can be risky if repayment depends on uncertain outcomes leading to debt. The interest rate, collateral and documentation requirements and the mode of repayment together make up what is called the terms of credit. That means the interest rate, collateral and documentation requirement and the mode of repayment together comprise what is called the terms of credit. These terms can vary significantly from one credit arrangement to another. They often depend on the nature of the lender, the borrower and the purpose of the loan. Now, loans from cooperatives. Besides bank, another major source of cheap credit in rural areas is cooperative societies or cooperatives. Members of a cooperative pool their resources to help each other in specific areas. There are various types of cooperatives such as farmers cooperatives, weavers cooperatives and industrial workers cooperatives. For example, the Krishak cooperative operates in a village near Sonpur and has 2,300 farmers as members. It accepts deposit from its members and uses these deposits as collateral to obtain a large loan from the bank. These funds are then used to provide loans to members. Once the loans are repaid, another round of lending can take place. Krishak cooperative provides loans for purchase of agricultural implements, cultivation and agricultural trade, fisheries, construction of houses and other various expenses. Cooperatives thus play an important role in providing accessible and affordable credit to rural members. Now, formal sector's credit in India. We have seen that people obtain loans from various sources. These loans can be grouped into formal sector loans and informal sector loans. Formal sector loans include loans from banks and cooperatives. Informal sector loans come from moneylenders, traders, employers, relatives, friends and others. The Reserve Bank of India supervises the functioning of formal lenders. For example, banks are required to maintain a minimum cash balance from the deposit they receive, and the RBI ensures this is followed. Banks are also required to lend not just to profit-making businesses but also to small farmers, small-scale industries and other small borrowers. Banks periodically submit information to the RBI about their lending, how much they lend to whom and at what interest, etc. There is no supervision for informal lenders. They can lend at any interest rate and may use unfair methods to recover loans. Compared to formal lenders, most informal lenders charge much higher interest rate. Higher borrowing cost means that a large portion of a borrower's income goes to repay the loan, leaving them with less for their own needs. In some cases, the amount to be repaid can exceed the borrower's income, leading to increasing debt and debt traps. High costs may also discourage people from starting businesses or farming. For these reasons, bank and cooperative societies need to lend more. Affordable credit allows people to grow crops, start businesses, set up small-scale industries, trade in goods and so on. Cheap and accessible credit is therefore crucial for the country's development. Most loans from informal lenders carry very high interest rate and do little to increase the income of borrowers. Therefore, it is necessary that banks and cooperatives expand their lending, especially in rural areas, to reduce dependence on informal sector borrowing. At the same time, it is important that formal sector loans reach everyone. Currently, richer households tend to receive most formal loans, while the poor often rely on informal lenders. To ensure equitable development, formal credit must be distributed more widely so that poor can also benefit from cheaper and more accessible loans. So, formal credit is distributed more equally so that poor can benefit from the cheaper loans. Now, self-help groups for the poor. We have seen that poor households often depend on informal sources of credit. Why is this the case? Yes, limited bank presence. Banks are not available everywhere in rural India. So the first reason is limited bank presence and the second reason is difficulty in obtaining bank loans. Even when banks are present, getting a loan is much harder than borrowing from informal sources. Bank loans require proper documents and collateral. The lack of collateral is a major reason why the poor cannot access the bank loans. Informal lenders, such as money lenders, usually know the borrowers personally and may provide loans without collateral. Borrowers can sometimes take additional loans even without repaying earlier ones. However, there are serious drawbacks. Money lenders charge very high interest rate. They keep no proper records of transactions. They may harass borrowers when collecting payment. This is where self-help groups or SHGs come in, helping the poor access credit more safely and affordably. In recent years, new methods have been tried to provide loans to the poor. The idea is to organize rural poor, especially women, into small self-help groups and pool their savings. A typical self-help group has 15 to 20 members, usually from the same neighborhood, who meet regularly and save money. Savings per member range from rupees 25 to rupees 100 depending on their ability to save. Members can take small loans from the group itself. The group charges interest, but it is lower than what a moneylender would charge. After 1 or 2 years, if the group is regular in savings, it becomes eligible to borrow from a bank. Loans are sanctioned in the name of the group and are intended to create self-employment opportunities for members. Example of loans provided by SHGs include releasing mortgaged lands, like meeting working capital needs, like buying seeds, fertilizers, raw material like bamboo and clothes. Then housing materials, like acquiring assets such as sewing machine, handloom or cattle. Most decisions about saving and loans are taken by the group members. They decide the purpose and amount of loans, interest rate to be charged and repayment schedule, etc. So SHGs help borrowers overcome the problem of lack of collateral. They can get timely loans for a variety of purpose and at reasonable interest rate. Moreover, SHGs are the building blocks of organization of the rural poor. Not only does it help women to become financially self-reliant, the regular meetings of the group provide a platform to discuss and act on a variety of social issues such as health, nutrition, domestic violence, etc. Now, Grameen Bank of Bangladesh. Professor Muhammad Yunus. Do you know about him? Professor Muhammad Yunus, the founder of Grameen Bank and recipient of 2006 Nobel Peace Prize. He emphasized the power of providing credit to the poor. He said, if credit can be made available to poor people on terms and conditions that are appropriate and reasonable, these millions of small people with their millions of small pursuits can add up to create the biggest development wonder. So the Grameen Bank's model showed that providing affordable credit to the poor, especially women, can empower them economically and socially, enabling them to improve their livelihood and contribute to broader development. So let's sum it up. In this chapter, we have explored modern forms of money and their connection with the banking system. On one side are depositors who keep their money in banks, and on the other side are borrowers who take loans. Economic activities often require loans or credit. Credit can have a positive impact, helping people earn more, or in certain situations, it can make the borrower worse off. Credit is available from various sources, which can either be formal or informal. The terms of credit vary substantially between formal and informal sectors. Currently, richer households tend to receive most of the formal credit, while the poor rely on informal sources. To promote equitable development, the total formal sector credit should increase, reducing dependence on expensive informal credit. And the poor should get a share of formal loans from banks and cooperatives. Implementing these steps is crucial for the economic development of the country. So that's all about this chapter. Thanks for watching. For more related contents, please do like, share and subscribe.